Exercise, we're going to go through the three main financial statements and talk about how they're related and affect one another. As an entrepreneur or small business owner, it is important to remember you do not need to be an accounting genius. There are just a handful of concepts you should be familiar with and understand that will help you when making your financial projections and when speaking with investors. So let's go ahead and zoom in here. We're going to start with the income statement, and we're going to focus on two items within the income statement. The first is going to be the net income number here. If you may recall, an income statement shows a company's operational performance over a specific period of time. The net income or net loss are the monies either generated or lost by the company's core operations over that specific period of time. So in this case, we see that the company made $5,850 in this time period. So let's jump over to the cash flow statement to see how this net income number flows through to the rest of the financial statements. So here we're at the cash flow statement. I'm going to go ahead and zoom in. As you can notice, the first line under operating activities is in effect the net income net loss number. And as you can see, it matches exactly what was found on the income statement. So conceptually, the net income number coming from the income statement is the first line item on a cash flow statement, and it drives the amount of cash that flows in and out of the business. As you can see below the net income level, there's a variety of non-cash adjustments as well as investing and financing activities that you have to take into account that will ultimately give you the cash flow in or out of the business. So let's go down here to where we see the increase and decrease in the cash and cash equivalents. So once you take into account what came in or out of the business for that period, and then you add or subtract that to the beginning cash balance, and then you arrive at an ending cash balance for this time period of $74,616. So let's jump over to the balance sheet. And as you can see here, first line item under the asset, the cash and cash equivalents line, is in fact $74,616. So actually, the balance sheet is linked to the cash flow statement. So the ending cash balance on the cash flow statement should equal the cash balance on the balance sheet. So if we take one step back, and starting with the income statement, if you take the amount of money a company's operations over a specific period of time either creates or loses, that flows through to the cash flow statement. You take into account other operating, investing, and financing activities, and you end up with an ending cash balance. And then that flows all the way back through to the balance sheet. One other item to note to show how some of the relationships among the financial statements are under the liabilities and owner's equity section. There are two components that are highlighted. First is the notes payable, which is the current portion of debt on the books that a company owes. In this case, it is $2,000. The second line item is actually under the bank loan. This is the longer term liability showing that the company owes $50,000 beyond the $2,000 it owes this year of the current portion of the debt. So to show how that's related with the other financial statements, let's jump back to the income statement. And what we're looking at here is what is called the interest income interest expense line. As you can see, this actually matches the $2,000 found in the current portion of debt within the current liabilities section on the balance sheet. So in a sense, this $2,000 is taken out of the company's operational performance because it had to pay that interest expense. So this $2,000 actually affects this net income, which as we showed before, flows into the cash flow statement and ultimately to the balance sheet. So you're creating this type of virtuous cycle.